Every 3 months, we get to see what the greatest investors in the world are doing with their portfolios, what they're buying, what they're holding, and what they're selling. And we have the update. We have the 13F filings for all what I consider the greatest investors in the world. In this episode, we're going to be doing an in-depth review into each of their portfolios and trades over the past 3 months. The goal here is to give insight and context into what each of these great investors are thinking and doing. And in my opinion, this episode, we have the best list of super investors to cover that we've ever had. Of course, we have Warren Buffett, but we also have Bill Ackman, Terry Smith, Dev Kantesaria, Josh Tarasoff, Pat Dorsey. We have Polen Capital, which is a great firm. Of course, we have Michael Burry, we have Chris Hohn, Mark Massey, and Chuck Akre. That is 11 super investors, the most we've ever covered in a single episode. We have a lot to get into. Let's go ahead and start off with the big man himself, Warren Buffett. When we look at Warren Buffett's trades, one thing that we always have to keep in context is that Warren Buffett always plays the long game. He builds things to last. He doesn't take any chances. The reason that he's had a record that goes 40 years without any disaster or any real problems with his companies is because he never takes big risks. And by big risks, he never takes things that could potentially destroy his firm, destroy his company. He never over-levers. He never gets himself into trouble. He builds things to last. So when we look at his portfolio, his stock portfolio in and of itself is worth around $266 billion. So in and of itself, just his publicly owned stocks are massive. It's like a S&P 500 huge company in and of itself. But that also doesn't factor in all the wholly owned companies that he has. So this is only around 30-40% of the overall portfolio of Berkshire. Now we can look at his current portfolio and we see the same familiar names here. We have Apple, American Express, Bank of America. He has Apple and all the financials. But the first thing that I notice is that Apple's going down in total percentage of his overall portfolio. It used to be 40% of his publicly traded portfolio. Now it's only 26%. He's reduced Apple another 25%, which is 8.75% of his overall portfolio. So this is a massive reduction in shares. He continually is reducing Apple. Why is Warren Buffett continually reducing his Apple position? I think the answer is simple. Apple's traded up to a valuation that's rather high. It's richly valued with a 31 forward PE ratio, a free cash flow yield that's 3%. When you factor in stock-based comp, which Warren Buffett absolutely does in his valuations, that takes it to around 2.8%. So the valuation has gone up for Apple. Warren Buffett's up 5x on this holding, maybe even more than 5x when you factor in his dividends. So he's made a fortune on it. The valuation's higher, and Apple's growth potential is looking a bit dimmed. It doesn't look quite as bright as it did when Warren Buffett initially bought into it. Overall, the calculation of the stock has flipped, and it makes sense that Warren Buffett's taking some off the table. He doesn't want quite as much exposed to a company with such a high valuation and with slower growth prospects. So this is how Warren Buffett handled his Apple position overall. He bought into it in 2016. This is a great time to be buying into Apple. He wasn't paying a lot during that time period. He held it all the way 2018, 2019. He trimmed the position slightly in late 2020. That was a mistake because Apple continued to soar up at that point, but not a big one because he still held the majority of his stake. Then in late 2023, he really started to trim the company. In Q1 of 2024, he sold a bunch of the company. This was breaking news. Now he's sold even more, and you can see that he's cut his Apple stake roughly in half over just the past 4 quarters. So Buffett is dumping his Apple position. He wants out of this company. He wants to reduce his stake in it. He's not talking about it during his shareholder meetings, and I think we outlined the reasons why. Now, when we look at Bank of America, this was his next largest trade. He sold down roughly 22% of his stake. If we look at this over time, this is the first major sell of Bank of America. But again, this one doesn't surprise me that much. I believe Warren Buffett thinks that the market, the economy, everything's getting overheated. We can see the surging of stock prices in the market, and I think he wants less exposure overall. So he's selling out of these companies with his major positions. He's raising a ton of cash. Right now, Berkshire has $320 billion in cash. They're gaining something like $15 billion a year in interest. And I think he doesn't mind that. He doesn't mind just sitting there with a ton of treasuries, paying him interest, not worrying about stock prices and what's going on with the economy. So he's selling out of those big companies, enjoying all the interest that he's getting on his treasuries. Another company that he sold out of, and this one was a bit shocking and disappointing to some investors, was his Ulta position. Warren Buffett bought into Ulta. It made a lot of news. It was all over social media, as a lot of people love this stock, and he completely dumped the company. It doesn't shock me that he sold out of Ulta. It is, after all, a very niche retailer, something that I couldn't see Warren Buffett holding long term. But if we look at his holding of this company, he bought into it at around $385 and sold at $389. So this is not a good trade from Berkshire. It was another one that really didn't move the needle at all. Now, other than that, the trades in his portfolio that stand out are two new positions. We have Domino's Pizza and Pool Corp. Now, keep in mind, these are very small positions for the Berkshire portfolio. Only 0.06%, 0.21%, so really small positions. But this does give these companies the stamp of approval from Berkshire, the stamp of approval from Buffett. It is true that it's probably one of his employees, his lieutenants, doing these buys, but Buffett always gives the stamp of approval. He's given the okay for these companies to make it in the Berkshire portfolio. So that in and of itself is good news for Domino's and Pool Corp. Now, I don't always agree with Warren Buffett's buys. In fact, I've been a vocal critic of many of the buys he's done, including his buy into Paramount. That was a mistake from the beginning. All they did was buy into that company and sell it much lower. Paramount is a subscale streaming company, very troubled company from the very beginning. So I was a vocal critic of him buying into Paramount, as well as Ally Financial. He bought that one right at the top of the car market. I thought it was a mistake, and that one didn't do well for Berkshire either. So I'm not always in agreement of what Berkshire is buying or what Warren Buffett's buying, but these buys into Domino's and Pool Corp, I think, are both great. I like both of them. Domino's and Pool Corp are both compounding machines. They are great companies with great legacies, great histories. They have great financials. If we look at Domino's, for example, this is the revenue line on a trailing basis, continually growing revenue over time. Looks very good, organic growth, a little slower than what I would prefer. But with Berkshire, you don't need the fastest revenue growth. You just need one that you're going to grow over time. The free cash flow shows a company that was surging up until 2020. That makes sense with the stay-at-home mandate. And then since then, the free cash flow has gone down a little bit. Sales have come down a little bit, but now you're seeing a resurgence. Domino's has finally normalized and it's starting to pick up again. And this is a super free cash flow positive company that trades at a decent valuation. Domino's has a long history of being a compounding machine. It is a franchise company. They're everywhere. They're easy to order. It's food that almost everyone likes. So this is a company that has very high upside. It's one that can continue compounding for years and years in the future. When I look at the company, I also think it has rather minimum downside. I don't think any pizza joint's going to outcompete Domino's. I think the valuation in terms of the forward PE ratio and the free cash flow yield are also rather low. So there's risk in every company, but I see this one as a great risk and reward for the Berkshire portfolio. Pool Corp is another one that I have to say I just like. I like this buy into the Berkshire portfolio. I think it fits well. I think whoever is deciding to do these buys is on the right track. Now, Pool Corp's an interesting company. If you're not aware of what Pool Corp does, it's all in the name. This company does everything with backyard pools. So think about your backyard neighborhood pool. Think about the pool itself and the construction, the materials. Pool Corp provides that. Think about the filters and the drains and the little vacuum machines that clean it up and the nets to sweep leaves and stuff off the top of the pool. Pool Corp provides all of that. Think about all the chemicals, the treatments, the measuring, everything that has to do with maintaining a backyard pool. Pool Corp provides all of that. Think about all the companies that go out and service pools and they come up with their vans and every single week they come in and make sure things are running well. Pool Corp provides all of the products that they use. Pool Corp has a monopoly on the backyard pool. That's what this company does. So when you're investing in Pool Corp, you're investing in the backyard pool and whether or not that's going to grow over time, whether the service business is going to grow. Now, obviously, they make a lot of revenue from first-time installers. So that's the biggest upfront cost. That's when you pay like $100,000 or whatever it may be to get a big backyard pool. But then it doesn't end then. When you install a pool, you know there's going to be some level of maintenance. So they make residual income selling all these products and chemicals to all their suppliers, all their maintainers after the pool's already installed. So as the pool base grows, so does Pool Corp's reoccurring revenue. Now, obviously, there's some skewedness in the revenue growth. It grew dramatically since COVID. People, again, want to have experiences when they're locked at home and they're bored. they start spending money and their stimulus checks and all of that low interest rate debt that they could get. They spent all of that on backyard pools. I saw the same thing. During the past couple of years after COVID, I saw so many people around me get backyard pools. Low interest rates, infusion of stimulus, you got yourself a backyard pool. Now, that hit a peak. Like every single pull forward of demand, it hit a peak and it started to go down. And I think what Berkshire is doing here is saying, this is probably close to the end of it. It's starting to normalize and we're going to see revenue growth relatively soon. So we're going to get ahead of that. We're going to invest in it now. Once the company starts seeing revenue growth, once it starts organically growing again, we can see the free cash flows grow over time. And it will end up growing again. This company has a monopoly. They have the marketplace. Pools are going to be a thing of the future. I like this buy. So regarding both of Berkshire's new buys, I like both of them. I think both of these are great. But overall, I think the message is clear from Warren Buffett. Right now, he's not an overall net buyer of stocks. He is a seller. He's hoarding cash. He believes the market's overvalued, and he doesn't buy into hysteria. So while the rest of us are celebrating stocks moving up every single day, Warren Buffett's fine just holding on to his vast empire of different companies that he's already purchased. He's fine having Berkshire make gains over time. He's fine collecting interest, but he's not going to continue paying a higher and higher price for companies. He will not buy into the hysteria that everyone else does. When eventually things turn around and we see those days where the market goes down 3% and 5% in a single day, and it becomes very scary, Buffett's going to sit there with $300+ billion in cash. So right now, Buffett is in defensive mode. And overall, I think that's the right positioning from Berkshire. Now, next up, we have the activist investor turned activist political commentator, Bill Ackman. Bill Ackman runs Pershing Square Capital. It's a firm that he started, and the hedge fund has had rather good performance. With 17% returns for the past 20 years, net of fees, that beats out the huge majority of hedge funds. So you can think what you want about Bill's politics, but the numbers speak for himself. He's a decent investor. When we look at Bill Ackman's portfolio, he currently manages around $12 billion. And one thing to note, this shows the US holdings. It doesn't show Universal Music Group, which is currently his largest position at around 15%. So just imagine right at the top here, there's UMG, Universal Music Group. That's his largest holding. Now, keeping that in mind, when we look at his most recent trades over the past 3 months, his biggest trade is buying into Brookfield Corp, ticker symbol BN. Brookfield Corp is an asset manager, an investment company. It's a bit of a REIT and real estate company managed by the charming Bruce Flatt. If you haven't listened to Bruce Flatt, just search him on YouTube. He's the CEO of the company. He's the one that's ran the thing for like 20+ years, and he's made most of his investors filthy rich in the process. The history is very illustrious for Bruce Flatt. He's had great returns for a long period of time, and he does all these specialized investments into huge infrastructure projects that have very predictable ROI. So it makes sense that Bill Ackman is attracted to this investment vehicle. He's upped his stake dramatically in this company, making it one of his largest positions. So he bought 10% of his portfolio weight in this company. In fact, almost 11%. A big bet into BN, which is interesting because when I look at BN and we look at the stock price, we can look at the stock price here. I don't know quite when he got into it, but here's the past 3 months. Unless he bought it right at the beginning of the past 3 months, he bought it during a stock surge. So it looks like he's not trying to get the best deal because this stock has been going up all year long and he just recently bought into it sometime right around here. So he thinks right now is a good deal. He doesn't have anchoring bias. He doesn't think he had to buy it here. He still thinks the future's good. And I think Bill Ackman might be right. Brookfield Corp likely has a bright future. The other company that he increased his stake in dramatically over the past 3 months is Nike. Bill Ackman has a history with Nike. He's invested in this company before. The last time that he invested in it, he bought it during a dip, during a 52-week low. He made a quick $100 million as the stock price just ebbed and flowed back upwards. And he's trying to do the exact same thing now. Nike is at a low. If we zoom out the past 5 years, look at this low. It was up to 180 back in 2021. And now the stock price is, let's see, it's at 74. So from 180 to 74, you got the brand logo, Nike. You got the history of Nike. This is one he's willing to take a big swing on and put 10% of his portfolio into the company. I think this is another decent buy by Bill Ackman. I see why he's doing it. It makes sense. Nike's a company to me that I still think has a bit more risk than what Bill Ackman and other investors think. Hoka wasn't a thing in 2019. On Shoes wasn't a thing in 2021. Brooks, Skechers making a comeback, New Balance signing a bunch of athletes onto their shoes. There's a lot of things that changed since 2020 that I think factor in to the stock price decline. But overall, even with my concerns about Nike, I still think this is a decent pick for Bill Ackman. Buying this company at the price he is, I think the risk reward is still rather good. It's definitely a positive risk reward. So when we look at the overall portfolio, one thing that looks a little different here than you might think is when you combine GOOG and GOOGL, when you combine both of that actually makes it at the very top of this list. So Google would be above Brookfield Corp here in his total portfolio weighting. Since he split it between the two tickers, it's way down here at the bottom. But for all intents and purposes, Google is one of his main positions right now. Then we have Brookfield Corp. Then we have Hilton, Chipotle, which he didn't sell any of over the past 3 months. I thought that was interesting. He's holding on during the little dip in Chipotle, wants to get a higher price point for the sale. Then we have Restaurant Brands International. I don't love this company's portfolio. Maybe he sees something I don't. Howard Hughes Corp, that's his own specialized deal in real estate. And then we have Nike, Canadian Pacific, and then a couple companies that don't even make up half a percentage. When I look at the trades of Bill Ackman, I like both of them. I like that he's buying Nike into weakness. I think that's a decent trade. And I like the Brookfield Corp addition to his portfolio. I think it's a great company with great stewardship over it. So Bill Ackman has a stronger portfolio today than he did 3 months ago. Good job, Bill Ackman. Next up, we have the legendary British investor Terry Smith that manages over $25 billion, and so far his performance has beat out the S&P 500 by a narrow margin, but the past couple of years he's made a series of blunders, particularly with his sells. He sold companies at the wrong time. He sold Amazon at a low. He sold Intuit right before it took off. He held on to PayPal too long and then sold it at a low. So he's made a series of mistakes and he's trying to make a bit of a recovery, trying to turn things around with this fund. Now, when we look at Terry Smith's latest trades, there's just not much here. For example, the biggest trade he made to his overall portfolio was selling a little bit of McCormick. He sold down 2.71%. So he sold 82% of his McCormick position. Basically, this is a way of saying that he's dumping the position. He wants to get out of McCormick. Now, McCormick is, of course, the spice maker. The company makes all the flavors. They're a flavor expert. When I look at this company, it's not one that I would invest in. And the reason why is simple. I do a lot of at-home cooking. I like cooking different meals. And my cabinet, my spice cabinet upstairs, is full of a million brands of spices that are non-McCormick. There's so many different ones that are great from different brands. And the truth is, I think this company is continually losing market share. There's so many flavor companies and spice companies. I see them on the shelves of Costco and Target and Smith's and Kroger's. Everywhere you go, they have their custom label brands, their private label. They have third-party brands that are non-McCormick. I just see more and more of that going on. So my simple taste test here, my sample size of the market is that this company is going to struggle to grow with this onslaught of competition coming in. And the revenue shows that. Look at the revenue of the company. It's barely growing. It grew 1% over the past 1 year. And that is, of course, not inflation adjusted. So it's actually shrinking in market share when you factor in inflation. So I like this trade. I like that Terry Smith is dumping McCormick and hopefully can do something else with the money. When we look at Terry Smith's portfolio overall, I would say it's very conservative. He has 40 different positions. He does weight them more heavily towards the top holdings, which are Microsoft and Meta. And I think overall, with this level of diversification, he's not going to see dramatic outperformance of the indices. His goal here is to protect the capital of his investors and grow it in a stable manner slowly over time. Now, next up, we have Kantesaria, who is quickly growing his portfolio to massive size. It currently has a value of over $4.5 billion. Just a couple years ago, he's only managing $1 billion. So he's 4x'd his portfolio. He's gotten more inflows from investors as he's had spectacular market-beating results. From both the QQQ and the S&P 500, Kantesaria has blown it away. He's starting to make a real name for himself. When I listen to Kantesaria speak and execute his strategy, he strikes me as a very high IQ individual and a very disciplined individual in executing his strategy. It's been incredible to see what he's really done with his portfolio. While we have so many investors out there, ones that I'm not covering in this video, but there's so many hedge fund managers, that they just copy the index. They make no bets into individual companies. They just spread out their bets amongst a ton of different companies and basically match the index. Dev does it differently. He makes significant, concentrated bets into companies with a deep understanding of what the company is, the pricing power of it, and the future value of it. The company that he did this with over the past 5 years is Fair Isaac, FICO. This is now 35% of the Dev Kantesaria Valley Forge Capital portfolio. 35%. Now, it didn't start that way. When we look at his most recent trades, he's starting to sell a little bit of the company. His biggest trade was only 3%. He trimmed 7% of his Fair Isaac position. So he's selling a little bit, but let's go ahead and just take a look at how he's handled this company over the years. If we look at the trading history here, he's had this one on the radar since at least 2018. So it's been a company that he's held around 300,000 shares of. But then in Q4 of 2020, Dev realized something with FICO, and he wanted to own the company. What did he realize during this critical time period? He realized that they were going for volume. FICO was making their score ubiquitous for 10 years, gaining market share over every other scoring alternative. And then he realized that they were implementing a structured pricing tier that would dramatically increase the price of the FICO score, up hundreds of percentages, making it so that their free cash flow with their huge volume would explode. Consider if Netflix, with their 280 million subscribers, was capable or able to raise their prices 5x in a single year, from $16 a month or $7 a month up to $70 a month or $100 a month. Of course, Netflix can't do that. Everybody would rebel. But with FICO, that's essentially what they did. They raised the prices hundreds of percentages, and nobody rebelled because the prices were so low to begin with, most people don't notice. Dev Kantesaria realized that this was on the horizon because of his studying of this company. He bought in heavily. In Q1 of 2021, he continued to hold, and then he bought more and more, especially with the inflows in the company. He got all the way up to a share count of 963 million shares. That was in 2022. And he held on to that share count through an epic surge in price of FICO all the way until Q4 of 2024. When we look at the prices here, he basically was buying into FICO when it was underneath the price of $700 per share. And that's when he started to sell. So as soon as FICO hit $700 per share, he started to trim the position just slightly, trimming 2% one quarter, 4% another quarter, 2% another quarter, only minus 0.34% this quarter. And then this most recent quarter is his largest trim he's done of FICO, trimming off 7.86% of his position. So when we look at this, he is selling every single quarter. But we look at the total sales by comparison, and he's not selling that much. Look how much he's reducing his position. He's only reduced it around 15% overall. And the share price has gone from $300 when he was first buying it up to $2,000 per share. Not only did he buy into FICO well, but he's handled his shares and holding of it very, very well. This should be looked at as one of the most significant, best trades ever from a super investor. Now that he did trim his FICO position a couple percentage points of his overall portfolio, he moved that money mostly into ASML. He doubled his position in ASML, and then he also bought a little bit more Moody's and a little bit more S&P Global, which I love seeing because I own both Moody's and S&P Global. If Dev Kantesaria is buying into the company, that's another stamp of approval that at least he thinks there's decent value here. He also gave a nice stamp of approval right now for ASML, and it seems obvious why he's buying the company right now. He's owned a bit of ASML, and it is in the red year to date. ASML has had its demand go down as we went through a big influx. We see the total net bookings here go down a little bit, and Dev Kantesaria is betting on a recovery in this share price. Now, the reason that he likes ASML from his own words is he says that basically right now there's a lot of AI companies. It's hard to predict which ones are going to be the winners, but he knows that at least ASML is going to make a lot of money during the next 10 years supporting all these various AI companies. Because ASML, of course, designs, manufactures, and implements these highly critical machines, these lithography machines that are critical in the production of semi-chips. So this plays a very important role in the overall AI theme for the next 10 years. He considers it a predictable player in that category. Now, not to be mistaken, ASML is still a very small position in his portfolio, only 2%. And other than that, he still holds relatively the same portfolio. Super huge weighting towards FICO, 35%. He loves S&P Global. He's owned this company for over a decade. He loves MasterCard, Moody's, Intuit, Visa, and so on. I think that he has one of the strongest portfolios in the market. The only real criticism I can think of Dev Kantesaari's portfolio here is that there's some overlapping factors with his companies. A lot of these have to do with debt markets and credit. So if the theme of debt markets didn't do well, if consumers took out less debt, if companies took out less debt, that would be a headwind for his portfolio. But I just don't think that's going to happen. Companies are going to take out more debt. Consumers are going to take out more debt. It's just the way of the world, and he's well positioned for it. Now, next up, we have the super investor, Josh Tarasoff, that manages a little over $300 million. So this is a small portfolio relative to other super investors, but I like that he has a highly concentrated portfolio, only in 9 positions. When we look at what's gone on with Josh Tarasoff over the past 3 months, he's done a series of sells. He sold 8% out of his Brookfield Corp position, 8% of his total portfolio, which is 33% of the position. He sold 6% of his portfolio out of the Microsoft position. He sold another 6% out of Amazon. He sold 1.5% out of Tesla, and so on. He didn't really do any buying last quarter. And what this means is that Josh Tarasoff needed to raise money to pay out some of his investors. This is called redemptions, meaning they invest other people's money. Sometimes, for different reasons, those people want their money back. Josh Tarasoff has to make sells to pay that money back. So I don't really see this as real trading or him building his portfolio. What I see is him selling the companies that have done exceptionally well over the past year. So overall, not much change quarter over quarter for Josh Tarasoff. He has a list of decent companies, but I still think his portfolio lacks any type of meaningful structure. He trades into companies and out of companies rather frequently. A number of his recent trades have not been great. So his trading has given me a little bit of pause. It's not a strategy that I would emulate. Now, next up, we have the super investor, Pat Dorsey. He's the guy that's originally behind the Morningstar moat analysis, where they try to dissect the different network effects or competitive advantages that a different company has. He's the one that developed that. And now he's since gone his own way, started his own fund, and he manages $1 billion. So he's doing quite well for himself. When we look at Pat Dorsey's most recent trades, there's one that's highly questionable right here. His biggest trade by far was buying a 10% position. So 10% into AppLovin. Now, AppLovin is the best performing stock in the market year to date. So in the entire S&P 500, basically in the entire stock market, this one has done the best. Up 667% year to date. This is a company that does AI marketing. It doesn't seem that exceptional, but when investors really found out about what they're doing, they started to buy it up. Now, what makes this investment so questionable by Pat Dorsey is the update is from the date of November 14th. So the update is from right, if we look at it right here, it's from right November 14th, right there. That's when the update occurred. So he could have bought this company at a price of $159, or he could have bought it at a price of $286. Did he buy it at $189 or $286? We have no clue. We just know that he bought it sometime 90 days before November 14th. So we don't know whether or not this was an incredible buy that he bought 87% lower, or whether it's a buy that's brand new and it might turn out well. But I can't really assess whether or not this was a great buy or not a great buy when I don't know what price he bought it. And with the huge change in share price, that really changes the calculation. The other trades that he did was he sold out a lot of Smartsheet. I think he sold this position to buy into AppLovin, and he sold a bit of SEMrush. There was a time period a couple years ago where I was really critical about Pat Dorsey. He was buying and holding and selling everything during the wrong time, destroying his investors' money. But he's really gotten that under control. I think he's really honed in his strategy over the past 2 years. He's held a lot of Meta, which is good. He's bought into AutoZone lately, which I think was a decent buy. He has Wix, and now he has the AppLovin buy. Of course, he's holding PayPal, which this one I find a bit questionable. But other than that, I see a list of decent companies here, and I like the most recent trades he's done. Next up, we have David Polen, or Polen Capital Management. This is more of a team effort. They have a big firm. They have a lot of analysts, but I really like what they put together. Right now, they're managing a staggering $38 billion. So there's a lot of trust put into these guys. I think they're doing a wonderful job. When we look at their most recent trades, they have made a couple trades that I do disagree with. One of them is selling out of Salesforce to buy more Apple and Oracle. So they sold their entire Salesforce position, 99.47%, so basically the entire thing. That was around 5% of their portfolio, and they bought into Apple and Oracle. Now, I think Oracle is an interesting buy here, huge cloud player, lots of growth, great ownership, so I like the Oracle buy, but I don't agree with selling out of Salesforce to buy Apple. When I look at Salesforce, it is true that the stock price has surged up recently, so I can see why they're doing this trade, why they've decided to take gains out of it, but Salesforce still has a lot of growth ahead of it. I'm not as concerned about all the AI talk as a lot of people are. I think Salesforce is still going to be relevant and growing in the future. The company also trades at a valuation that's very similar to Apple's. The same PE ratio, around the same free cash flow yield, but Salesforce is growing its revenue much faster and growing its free cash flow per share much faster. So in my opinion, and again, there's no guarantees here, but I believe that Salesforce over the next 5 years is going to outperform Apple. That would be my guess. So I don't think this is the optimal buy and sell, but I also don't think it's going to be overly destructive. They have their reasons for trading in and out of companies. The other things that they're doing is they're doing a series of small trims in Microsoft, Nike, which I think is interesting. They're selling a little bit of Nike right now. I don't agree with that one. They also sold a little bit of Amazon and Google. Again, other sells that I don't really agree with. So even though I could nitpick their trades, I think that their strategy overall is good. The list of companies is good, and I believe that this portfolio will beat the market over time. Now, next up, we have the super investor Chris Hohn that is one of the best. He manages a staggering $44 billion. The TCI fund that he runs has been consistently outlined as one of the best performing hedge funds out of any hedge fund. It's always towards the top, and he doesn't mess around. No messing around with this portfolio. He only has 10 holdings, and all of these companies are incredibly powerful business models. The one that I don't understand the most is his top holding, General Electric. But Chris Hohn studies these companies, he understands them. He bought this one at a wonderful time. He really bought it on a low. It surged up in price, so it's become a bigger position in his portfolio. His other portfolio holdings mimic the small world of high-quality super investor portfolios. You'll have some familiar names like Moody's, S&P Global, Microsoft. You have the railroads, Canadian Pacific, Visa, Canadian National Railway, and then of course he has Google in the portfolio as well. Overall, a very strong list of companies. The biggest trade he made last quarter was a very, very small trade. He slightly trimmed his Microsoft position to buy a little bit more Canadian National Railway. That was it. He trimmed 1.4% of his portfolio to buy 1%. So almost no change to his portfolio. It's the same over the past 6 months. And that's a common theme you'll see with these type of high quality investors. The better decisions they make, the less they have to trade and the better performance they have. He's beat the market for a long period of time, and he's done so with very minimal trading. He's not buying and selling companies all the time, doing all these different technical analysis techniques. He's just buying into high quality monopolistic companies, holding them long term. Now, next up, we have the man Michael Burry himself of the Big Short fame. And the only way to really describe his latest purchases is a big bet into China. He bought a lot more, in fact, a huge portion more of JD, of Baidu, and of Alibaba. So he's buying more and more into Chinese retailers. He's going where no one else wants to go. Michael Burry is dispassionate. He likes to look for the raw numbers. He likes to look for where he sees a lot of value. And obviously right now he sees it in China. Now, I have to be honest here. I don't really like these buys because I've dealt with Chinese stocks once. I dealt with Alibaba. And it's just so much of a headache. Dealing with the Chinese government and the way that they manage their companies, you really never know what's going to go on. But Michael Burry prefers that risk and reward over the risk and reward in the US with higher price equities. So the biggest trade he's doing by far is his shift into China. Another one that I think is notable is he likes Shift4 payments. Shift4 is overall a great payment processor. They're growing in a lot of verticals. I see their software expanding and trying to get a bigger total addressable market. So I like seeing that one there. But again, overall, when we look at his current positions and the way that he's tilting his portfolio, it's with a significant bet into China. Another thing that we don't see in this portfolio is his options. Michael Burry likes to exercise options all the time, so we don't know fully what he's doing with his investments. And this is why I'd give caution into following Michael Burry. For the most part, it's interesting to look at, but I think he's very difficult to follow as an investor. Next up, we have the very concentrated portfolio from Mark Massey of AltaRock Partners. They manage $5 billion and it's only in 9 positions. Now, they have done a decent amount of trading over the past 3 months. They added to their Amazon position by 30%. They sold 37% of their Visa position, and they put that money, as well as an additional amount, into MasterCard, over doubling the position. Now, this is an interesting trade. They are selling out of Visa to buy MasterCard. In my opinion, both of these are great companies, but I definitely think that MasterCard has the advantage, and that is because of their international growth. I believe MasterCard is better positioned to grow faster than Visa. The AltaRock portfolio is similar to other high-quality super investor portfolios, where they're investing the majority of their money in the same group of exceedingly high-quality companies that continue to have very prosperous-looking futures. We have the same names like FICO, MasterCard, Visa, Moody's, Google. Google's a very common one that we're seeing in this group of investors. We also see, of course, Microsoft, Amazon, and this one's unique holding, the one that makes AltaRock different, is their top position is TransDigm. So that may be an interesting one to look into if you like their other positions, and these ones align with your investing strategy, and you see an investor go so heavily into one company that you don't know as well. Typically that means that you might want to look into it, see what they see in this company. Next up, we have the Chuck Akre portfolio. Now, it's important to note that Chuck Akre himself, the legend, is no longer managing this. He's basically retired, and he's implemented a team to try to do the same things he was doing, to try to implement the same strategy. But it's very difficult to have the same fine touch that Chuck Akre had with his portfolio. They manage $12 billion, and since their team has taken over, they've continually sold out of some of their best positions, Moody's being one of them. Since around Q1 of 2023, they've been dumping their Moody's position more and more and more, and we see more selling of Moody's in the most recent quarter. And no matter how hard I try, I can't figure out why they're selling it. Is it valuation? They usually don't sell because of valuation. But to me, that's the only real concern. Moody's has gone up in valuation, but typically it's been a very strong trait of Chuck Akre to never sell because of valuation, to just hold on to quality companies because decades later, they'll be worth even more and they'll generate a ton of cash flow. This is a position that right now Chuck Akre's team is selling out of, Dev Kantesaria is buying into. So you can see the juxtaposition there. One of them is continually selling out of this high quality position, another one's buying into it. I agree more with Dev's side. Now, the company that they're buying into is Airbnb. They added almost another 2% to this position. I look at Airbnb and I think it's a fantastic company. So this is one that I don't disagree with. My pick has been Booking Holdings. I think they have some unique advantages over Airbnb. But I see that Airbnb has a new story to it. It has huge network effects. They really do have a very wide moat company at this point in time. It's an asset-light business model. And with those strong network effects, I can see why it's attracted the team of Chuck Akre. My only criticism here is that they're selling one very high-quality company to buy another high-quality company. It's not really the best trade in my mind. I think they should look for other places to raise cash to buy Airbnb. Other than that, the Chuck Akre portfolio looks very similar to last quarter. They have MasterCard as the largest position, Moody's, KKR, American Tower Corp. This is one that they've talked glowingly about for a long period of time, the very high return on capital from that company. We have Brookfield Corp, we have O'Reilly, we have Visa, Roper Technologies, and so on and so forth. Even though I don't agree with some of their recent trades, I don't think they're all that bad, and I still believe that this is a very strong portfolio overall. So that is the final update of the super investors. Across their portfolios, a couple common themes I've noticed is, first of all, they're being very disciplined, and I would say even reserved with their buying. They're not buying companies left and right. They're not scooping up different companies over and over again. What they're doing is being a little bit conservative. They're being discerning. They're being a little cautious with their buying. Warren Buffett leading the charge there, holding an enormous amount of cash and not doing many buys, and in fact selling a little bit. So I see overall a defensive posture. Another common theme that I noticed is just a lot of holding. A lot of them are just holding onto their companies. Most of them are not doing big sells, but they're just holding what they already own. I've also noticed a lot of Google, and this is a company that I own. I think it's one of the few that's at a half decent valuation right now. And it's also a great company. There's some fears regarding Google, so it makes sense that people are cautious about it right now. But I've noticed Google in a lot of these super investors' portfolios. So overall, there's the update. Let me know what you think. We'll have more content in the future. See you next time.